You have $10,000 saved. Where do you put it? A savings account? A hot stock your friend told you about? Real estate? If you're frozen, afraid of making the wrong choice, this episode is for you. Welcome to MonsterInvest, the channel where we tame the complex monsters of finance and investing. I'm your host, Eric. So, you've done it. You've decided to start investing. You've saved up some money, you've opened an account, and you're staring at the trade button on your screen. And suddenly, you're frozen. Absolutely paralyzed. You're hit with a wall of noise, a hurricane of conflicting advice from every corner. Your YouTube feed says, buy this stock. It's the next Tesla. Your colleague at work says, invest in this fund, my guy made me 20% last year. Your parents are telling you, real estate is the only real wealth, son. Then there's the crypto enthusiast friend yelling, crypto is the future. You're missing the rocket ship. All while a financial news anchor gravely warns, bonds are safe, you need ballast, immediately followed by another expert shouting, bonds are dead. Interest rates are too low. It's overwhelming. It feels like walking into a massive, complicated kitchen, a professional chef's kitchen, with thousands of ingredients you don't recognize. And all you wanted to do was make a simple, nutritious sandwich. Where do you even begin? You begin by understanding your ingredients. In the world of investing, we call these asset classes. Forget the jargon for a second. An asset class is just a category of investments that share similar characteristics and tend to behave in a similar way. Think of it like building a team for a critical mission. You wouldn't build an entire team out of only explosive experts, right? You'd get blown up at the first sign of trouble. You also wouldn't build a team of only negotiators. You'd never get past the front door. You need a mix. You need the specialist who can pick the lock, high growth, the steady hand who can read the map, consistency, the long-range planner who has the escape route, long-term security, and the solid defender who watches your back, capital preservation. Today, we're going to build that team. We're going to meet the core asset classes, stocks, mutual funds, real estate, bonds, and even cash. And to do that, I want to tell you a story about someone, let's call her Sarah. Sarah is 32 years old. She's smart, works hard in her tech job, and she's a great saver. For the last 5 years, she's been diligently, religiously, putting away 15% of every single paycheck. But all of it, every single dollar, is sitting in a standard savings account at her bank. Sarah's investment monster isn't greed, it's fear. A deep, cold fear. She vividly remembers Thanksgiving in 2008. Her uncle, a proud man, looked hollow. He had lost nearly half his retirement savings in the financial crash, all because he was too heavy in bank stocks, as he put it. Sarah's takeaway from that? Investing is gambling. The house always wins. Staying in cash is safe. But here's the problem, Sarah is losing. She just doesn't see the thief. She's losing to the invisible, silent monster called inflation. One night, she does the math. The money in her savings account is earning a pathetic 0.5% interest. But the cost of everything around her, her rent, her groceries, the cars she wants to buy, is going up by 3 to 4% per year. She realizes her safe money has lost over 10% of its purchasing power in just 5 years. She hasn't lost money, but she can buy less with it. She's running on a treadmill and slowly moving backward. This realization panics her. Her fear of losing switches to a new, sharper fear, the fear of missing out. FOMO. A week later, at a coffee shop, she overhears a friend talking about a hot stock called EcoInnovate, a new green energy company. Her friend is ecstatic. I doubled my money in 6 months, man. It's changing the world. Sarah feels a jolt. This is it. This is how I catch up. So, in a desperate pivot, she does a complete 180. She transfers $10,000, a huge chunk of her hard-earned savings, and dumps it all into EcoInnovate. She didn't read a financial report. She just read a few glowing headlines and listened to her friend. For 2 weeks, she is a certified genius. The stock soars 20%. She's euphoric, checking her phone every 5 minutes, calculating her future wealth. Then, the quarterly earnings report comes out. The company missed its targets. Badly. A major competitor simultaneously announces a breakthrough in battery technology, making Eco-Innovate's product look obsolete. The stock doesn't just dip, it plummets. It's a bloodbath. In 3 days, Sarah's $10,000 investment is worth $4,000. Nauseous, she sells in a blind panic, locking in her $6,000 loss. Sarah just got hit by both extremes. First, she was too safe and got eaten by inflation. Then, she was too reckless and got burned by volatility. What Sarah was missing was a plan. She didn't understand her ingredients. She didn't have a team. She just had one very nervous goalkeeper, her cash, and one very wild, unpredictable, and ultimately injured striker, her single stock. This is where asset classes come in. Let's break down the main players Sarah should have known about. First, the most famous player, the star quarterback, stocks. A stock, or equity, is simple, it's a tiny piece of ownership in a single company. When you buy a share of Apple, you literally own a microscopic fraction of Apple, with a claim on its future profits. The pro is obvious: if the company does incredibly well, if it becomes the next Apple or Amazon, your share price can go to the moon. This is the sports car of investing. It's fast, it's exciting, and it has the highest potential for long-term growth, historically beating all other asset classes. The con is what Sarah experienced. It's volatile. A single company can fail. A bad CEO, a new law, a product flop, a competitor, and your investment can be wiped out. Remember Blockbuster? Remember Nokia? Even great companies can stumble. This is high risk, high reward. You are putting all your faith in one single horse. Now, Sarah was terrified of picking the wrong horse. So, what if she could just bet on all the horses in the race? That brings us to asset class number 2, mutual funds and ETFs. A mutual fund or an ETF, which stands for exchange-traded fund, is not an ingredient. It's a recipe book. It's a basket that holds hundreds or even thousands of different assets. Instead of buying just Apple, you buy an S&P 500 ETF. Now, for a few $100s, you own a tiny piece of Apple, and Microsoft, and Amazon, and Google, and 496 other large companies. This is the tour bus. It's not as fast as a sports car. It's not going to double your money in 6 months. But it's incredibly reliable. Why? Because if Eco-Innovate, one company in the fund, goes bankrupt, Sarah barely notices. It's just one tiny part of her 500-company portfolio. The other 499 companies cushion the blow. This, my friends, is the single most important concept in investing: diversification. It's the art of not putting all your eggs in one basket. A quick note: mutual funds and ETFs are similar, but a key difference is that ETFs trade all day long like a stock, while mutual funds are priced just once at the end of the day. For most beginners, a low-cost index fund ETF, which just passively copies a whole market like the S&P 500, is the simplest, cheapest, and most effective way to start. Okay, so Sarah can buy stocks, the sports car, or funds, the tour bus. What else is there? Let's talk about asset class number 3, real estate. This is the asset you can touch. It's the house of investing. You buy a physical property, an apartment, a duplex, an office building. The pros are powerful. It's a tangible asset. People will always need a place to live or work. You can rent it out, creating a steady stream of income. We call this cash flow. Plus, you can use leverage, using the bank's money to buy a large asset, which can amplify your returns. And, over the long term, property values tend to rise. The cons are, well, it's a house. It needs a new roof. The toilet breaks at 2 a.m. You might have a tenant who doesn't pay for 3 months. It's also very illiquid, meaning, you can't sell it in 30 seconds like a stock. It can take months, and you pay hefty transaction costs to agents and lawyers. And, of course, it costs a lot of money just to get started. For people like Sarah, who don't have $100,000 for a down payment, there's an alternative: REITs, or real estate investment trusts. These are funds that trade on the stock market, but they only own properties, malls, data centers, apartment complexes. So you can get the benefits of real estate cash flow without having to be a landlord. Next up, the and more. This is the steady, boring, but critical player on the team. This is asset class number 4, bonds, or fixed income. When you buy a stock, you become an owner. When you buy a bond, you become a lender. You are lending your money to a government, like a U.S. Treasury, or a large corporation, like Apple, for a fixed period. In return, they promise to pay you a fixed amount of interest, called a coupon, every year, and then give you all your original money back at the end, at maturity. This is the reliable train. It's not fast. It's not sexy. Its goal isn't to make you rich, its goal is to keep you rich. The pro is stability. Bonds are the defense for your team. When the stock market, the sports car, crashes, fearful investors often flee to safety, which means they sell stocks and buy bonds, often pushing bond prices up. They provide balance and reduce the terrifying ups and downs of your portfolio. The con is lower returns. You are trading high growth for high safety. And, like Sarah's savings account, they can be hurt by high inflation. Finally, let's talk about the asset class Sarah knows best, cash. Yes, cash, and cash equivalents like high-yield savings accounts or money market funds, is an asset class. We know its weakness: inflation eats it alive. So why hold it? 1. For your emergency fund. This is 3 to 6 months of living expenses. This money must be safe, liquid, and never exposed to market risk. This is not an investment, it's insurance. 2. For short-term goals. Like Sarah's house down payment. Money you know you need in the next 1 to 3 years should be in cash or cash-like assets. 3. As dry powder. This is cash you keep on the sidelines, waiting for an opportunity, like when the stock market has a big crash, and you can buy great assets at a discount. So, stocks, funds, real estate, bonds, and cash. These are the core asset classes. Let's go back to Sarah. She now understands the ingredients. She knows the sports car, stocks, the tour bus, funds, the house, real estate, the train, bonds, and the insurance, cash. How does she build her new portfolio? First, she realizes her goal isn't just get rich. She has 3 distinct goals. Goal 1, an emergency fund, immediate safety. Goal 2, save for a house down payment in 5 years, medium term. Goal 3, save for retirement in 30 years, long term. These 3 goals need different teams. For Goal 1, her emergency fund, she takes $20,000 of her savings and puts it in a high-yield savings account. It's safe, it's liquid, and it earns some interest to fight inflation. This is her goalkeeper. For Goal 2, her retirement, 30 years away she can handle the market's ups and downs. Time is on her side. She builds an aggressive team that is 80% tour bus, a low-cost, total stock market ETF, and 20% train, a total bond market ETF. This is her high-growth team. For Goal 3, her house down payment, 5 years away she can't risk another eco-innovate crash. She needs that money to be safe. So she builds a conservative team. This one is 70% train, a short-term bond fund, and 30% tour bus, a stable S&P 500 ETF. It's stable, safe, and designed to just beat inflation. And that's $6,000 she lost. She now sees it as the tuition fee for the most important class she ever took. She no longer looks for one winning stock. She builds a portfolio of asset classes designed to match her goals. She's not gambling anymore. She's investing. So, before we wrap up, let's do a quick summary. What we learned today. 1. An asset class is just a category of investments. The 5 main ones for most people are stocks, bonds, real estate, cash, and the funds, mutual funds/ETFs, that hold them. 2. Each class has a different risk and reward profile. Stocks, sports cars, offer high growth but high risk. Bonds, trains, offer high stability but low growth. Cash, insurance, offers safety but loses to inflation. 3. The single most powerful concept is diversification. Don't bet on one company. Use mutual funds or ETFs, the tour bus, to buy a basket of hundreds of them. This is your best defense against one company failing. 4. The most important question is not, what's the best investment? The right question is, what is my goal and my time horizon? Your investment strategy must be built to answer that question. A long-term goal, like retirement, needs a different team than a short-term goal, like a down payment. The goal of investing isn't to find the one magic ingredient. It's to learn how to be a chef, to learn how to combine these ingredients into a balanced, sustainable meal that will feed you for the rest of your life. Thank you for tuning in to MonsterInvest. I hope you now feel more confident about the building blocks of your financial future. What's your investing story? Are you like Sarah, sitting in cash? Or did you get burned on a hot stock? Let us know in the comments on our YouTube channel. We read all of them. And if you found this helpful, please like and subscribe. It's the best way to help us tame more financial monsters. Next episode, we're tackling a big one, active versus passive investing, why Wall Street might be picking your pocket. You don't want to miss it. Until next time, I'm Eric. Invest wisely.